$4.4 billion deal promised a digital reinvention. In 2015, Verizon Communications announced it would acquire AOL for approximately $4.4 billion. The year mattered. Mobile subscriptions were stable. Wireless growth had slowed. Revenue still flowed predictably, but the category that once delivered expansion was now delivering maintenance. Inside the company, capital allocation debates had shifted from network scale to adjacency strategy. The acquisition was framed not as diversification, but as infrastructure extension, advertising technology layered on distribution capacity. Verizon operated with mechanical reliability. Wireless growth had slowed, but cash flows remained predictable. The board debated capital allocation, spectrum auctions, network scale, or something adjacent. The AOL acquisition framed digital advertising as infrastructure extension, technology, not content. The procedural logic behind the acquisition appeared consistent with that confidence. AOL was not treated as a media company. It was treated as an advertising platform with programmatic capabilities. Analyst presentations emphasized data, mobile video, and ad tech integration rather than content libraries. The deal documentation described technology assets, measurement systems, and revenue synergies. The language was technical, not narrative. Yet one structural irregularity quietly entered the system. Advertising economics did not resemble telecom economics. Wireless investment operated on multi-year depreciation schedules. Customer churn was measured in fractions of a percentage. Advertising markets recalibrated quarterly. Pricing volatility was normal. Platform competition was asymmetrical. The shift did not invalidate the acquisition thesis. It altered the time horizon under which performance would be evaluated. Within months, reporting lines began adjusting. AOL executives retained operational autonomy but entered new oversight structures. Financial reviews aligned with telecom reporting requirements. Forecasting assumptions migrated toward consolidated revenue frameworks. Committees designed for network investment now reviewed digital platform metrics. The mechanics of integration were procedural, not cultural. Two interpretations emerged simultaneously. From corporate finance, the acquisition created optionality in high-growth digital advertising segments. From operating divisions, the acquisition introduced revenue streams governed by unfamiliar volatility. Both interpretations referenced identical performance dashboards. They diverged only in what constituted acceptable variance. 6 months later, the acquisition logic expanded. In 2016, Verizon agreed to acquire Yahoo's core internet assets for approximately $4.8 billion. The scale nearly matched the prior transaction. The narrative again emphasized technology and advertising reach rather than editorial identity. Yahoo's properties were described as audience aggregation mechanisms. Synergies were modeled through platform consolidation rather than content strategy. Externally, the move resembled acceleration. Internally, it resembled continuity. Wireless growth constraints persisted. Investor expectations for adjacent expansion remained. The board evaluated transactions under familiar frameworks: strategic fit, earnings impact, integration feasibility. The second acquisition did not introduce a new direction. It increased exposure to the same adjacency. A procedural complication surfaced during closing. Before completion, Yahoo disclosed major historical data breaches. Valuation adjustments followed. Purchase price renegotiations occurred. The irregularity was documented as financial recalibration, not strategic reconsideration. The acquisition proceeded under modified terms. The event did not halt integration. It redefined assumptions embedded within it. By 2017, the assets were consolidated under a new structure. Verizon combined AOL and Yahoo into a subsidiary branded Oath. The naming decision functioned as organizational abstraction. Individual platform identities resided within reporting systems. The structure centralized advertising technology, media properties, and analytics capabilities. Integration progressed through systems alignment, budget consolidation, and performance metric harmonization. 3 operational shifts occurred in sequence. First, revenue projections incorporated cross-platform advertising assumptions. Second, cost efficiencies were modeled through organizational consolidation. Third, performance evaluations migrated toward aggregated digital metrics rather than asset-level analysis. All three shifts stemmed from a single constraint. Scale was necessary to compete with dominant digital advertising platforms. Fragmentation limited bargaining power. Consolidation was not optional. It was structural arithmetic. The integration thesis depended less on asset performance and more on category positioning. External narratives simplified the situation. Media coverage described Verizon as building a competitor to Google and Facebook. Investor commentary framed the subsidiary as a digital growth engine. The language compressed distinctions between telecom infrastructure and advertising platform economics. The comparison created coherence. It also introduced expectations calibrated to different operating models. Inside Oath, performance variance widened. Advertising markets fluctuated. Platform engagement metrics shifted. Legacy properties encountered declining traffic. Revenue trajectories deviated from projections embedded during acquisition modeling. None of these outcomes constituted procedural failure. They reflected category dynamics previously acknowledged but insufficiently weighted within consolidated forecasts. Then a constraint cascade accelerated. Impairment assessments became unavoidable. Accounting standards required evaluation of goodwill and intangible asset valuations. Market conditions influenced discount rates. Performance gaps triggered write-down considerations. Financial mechanisms, not strategic debates, now dictated institutional response. In 2018, Verizon recorded a $4.6 billion impairment charge. The number approximated the combined acquisition values. The adjustment did not eliminate the subsidiary. It recalibrated balance sheet representations of expected future cash flows. Public disclosures emphasized accounting treatment rather than operational abandonment. The event altered investor perception. It did not immediately alter structural integration. Two interpretations diverged again. Externally, the acquisitions were classified as strategic miscalculations. Internally, the impairments were treated as financial normalization within volatile markets. Both interpretations referenced the same filing. They differed only in what constituted deviation from plan. Organizational signals began shifting. Leadership changes occurred within Verizon Media, the renamed successor to Oath. Strategic emphasis migrated towards selective asset optimization rather than platform-scale competition. Cost structures tightened. Portfolio rationalization discussions intensified. The subsidiary's role within Verizon's broader strategy narrowed. A previously distant acquisition now resurfaced. Tumblr, originally acquired by Yahoo in 2013 for approximately $1.1 billion, was sold for a reported fraction of its purchase price in 2019. The transaction was procedurally modest, financially immaterial relative to Verizon's scale. Symbolically, it marked visible contraction of earlier expansion assumptions. Asset divestiture did not reverse acquisition logic. It documented recalibrated expectations. Strategic priorities continued adjusting. Verizon's capital allocation gradually recentered on network investment, 5G infrastructure, and core connectivity operations. Digital media ambitions did not vanish. They diminished in structural prominence. Governance discussions increasingly emphasized operational focus rather than adjacency scale. By 2021, Verizon agreed to sell Verizon Media. The buyer, Apollo Global Management, acquired the subsidiary for approximately $5 billion. The number resembled recycling rather than expansion. Verizon retained a minority stake. The divestiture did not frame prior acquisitions as errors. It framed portfolio optimization under evolving priorities. Externally, the narrative stabilized. Media commentary referenced acquisition failures, impairments, and strategic retreat. Internally, the sequence reflected institutional adaptation under shifting constraints, market volatility, platform dominance, capital discipline, investor expectations. Decisions appeared discrete. Their dependencies were sequential. What initially resembled acquisition failure exhibited a different pattern. The telecom operating model optimized for stability encountered advertising markets optimized for variance. Forecasting frameworks designed for predictable cash flows confronted engagement metrics governed by platform competition. Governance mechanisms designed for infrastructure investment evaluated assets whose value depended on behavioral economics. Each procedural step introduced new constraints. Acquisition created integration requirements. Integration created scale expectations. Scale expectations created performance thresholds. Performance thresholds triggered impairments. Impairments narrowed strategic flexibility. Divestiture reallocated capital discipline. No decision required reversal while occurring. Each decision functioned as continuation within institutional logic prevailing at that moment. Wireless growth constraints justified adjacency exploration. Digital scale imperatives justified consolidation. Accounting standards justified impairments. Portfolio optimization justified divestiture. The external narrative compressed complexity into outcome. Acquisition failures suggested flawed judgment. Strategic retreat implied miscalculation. Financial impairments indicated value destruction. These interpretations aligned with observable numbers. They obscured structural dynamics governing decision sequences. The Verizon file documents completed transactions, consolidated platforms, recorded impairments, and eventual divestiture. The question it does not answer, whether the acquisitions failed, or whether telecom logic simply encountered markets governed by different mathematics.